This year, the full new state pension pays £12,548. The tax-free personal allowance sits at £12,570. That gap is £22, and one decent triple lock increase closes it completely. Next year, that £22 gap turns into £442. HMRC takes £88 straight off your state pension. No letter arrives explaining why your bank balance is a little lighter. It just happens through your tax code. And if you have even a small private pension sitting alongside your state pension, that bill doesn't stay at £88. It triples, sometimes quadruples, because every extra pound of income above that frozen line gets taxed the moment it lands. There is a concession from the government for pensioners with no other income at all. It sounds like it should help most people. It doesn't. Fewer than 1 in 16 pensioners actually qualify. The rest of us, anyone with a workplace pension, a small SIP, savings interest ticking along in the background, we're left facing a tax bill that grows every year. The personal allowance stays frozen in place. I've watched people who did everything right end up owing tax for the first time in their lives. Not because they earned more, because the allowance never moved and their pension did. But the frozen allowance isn't even the most expensive trap waiting for you. There's a gap year buried in the system that can strip away 2 full years of state pension payments without you noticing until it's too late. There's also a tax code mistake on your very first pension withdrawal that can cost you thousands while you wait months for HMRC to hand it back. I'm going to walk you through both and the 10-minute fix that shuts the emergency tax trap down for good. Here's the cold arithmetic for next tax year. The full new state pension rises to roughly £13,012. The personal allowance stays exactly where it's been, £12,570. That leaves £442 of taxable income sitting on top of a pension you already paid national insurance for over decades. Income tax on that £442 comes to £88. It doesn't stop there. By 2029-30, the annual tax bill on the state pension alone climbs to around £220. And that's before you add a single penny from anywhere else. A £100 a month annuity, a small workplace pension, even bank interest that used to sit quietly under your personal savings allowance, all of it now stacks on top of a state pension that's already using up your entire tax-free allowance on its own. The part that catches people out is different from what you'd expect. This tax doesn't arrive as one bill you can plan around. It gets collected through your tax code, in small amounts, month after month, for the rest of your life. There's no single moment where you decide whether to pay it. It just happens quietly in the background, and most pensioners only notice when they compare this year's take-home pension to last year's. Why does this keep happening? It comes down to something called fiscal drag. The personal allowance has been frozen since 2021, and it's due to stay frozen until at least 2030. Meanwhile, the state pension rises every year under the triple lock, whichever of inflation, wage growth, or 2.5% turns out highest. Two numbers moving in opposite directions were always going to collide eventually. This is the year they finally cross. The government did add a concession in the 2025 budget. Anyone relying solely on the state pension with no other income at all gets a mechanism that stops them actually paying the tax. It sounds generous until you look at who it covers. Fewer than 1 in 16 pensioners have no other income whatsoever. Most people reading their pension statement have a small workplace pension, some savings, maybe a part-time income. All of that pushes you outside the concession and back into paying the tax in full. This isn't your fault. You saved. You paid your taxes for decades. You played by the rules that existed at the time. Then the goalposts moved while nobody was watching, and the allowance that used to comfortably cover your state pension now falls short of it. The trade-off here is easy to miss. Every year you don't adjust your other income sources around this, the tax bill compounds quietly against you. It isn't a one-off shock, it's a permanent fixture of retirement now, and it will only grow as the state pension keeps rising under the triple lock while the allowance stands still. but losing £88 a year is genuinely the smaller problem. The real damage comes from something almost nobody sees coming until it happens to them, a gap in your state pension that can cost you 2 entire years of payments. If you were born between the 6th of April 1960 and the 5th of April 1970, there's a specific trap hidden in the way your state pension age was raised, and almost nobody explains it properly. Take June, born on the 18th of March 1960. Her state pension age is 66, and she reached it in March this year. You'd expect her first payment to land straight away. It doesn't. Her first payment doesn't arrive until she turns 67, a full year later. That's £12,548 gone, not delayed, gone. And because of how the system calculates her exact date, she also loses a second year of the increases that would have built on top of that first payment. Add it up, and Jean is roughly £8,000 worse off in today's money, simply for reaching state pension age at the wrong point in the transition. Most people in this position do the obvious thing. They draw money from their private pension to cover the gap while they wait. That feels like the responsible move, and in most other circumstances it would be. But here's the mechanism nobody warns you about. Any money you draw from a private pension counts as income when the Department for Work and Pensions calculates your pension credit or housing benefit. Draw £8,000 to bridge the ghost year, and you can push yourself straight over the pension credit threshold of £218.15 a week for a single person. Lose that, and you're not just missing a year of state pension. You're losing £3,000 a year or more in benefits that were quietly keeping your retirement afloat. That's the trade-off most advice completely ignores. The fix that looks safest, using your own private pension to cover the gap, is often the one that costs you the most in the long run, because it counts against you exactly where it hurts. There is a better way to bridge it. Take your 25% tax-free lump sum from your pension, or draw from an ISA instead, and neither counts as income for benefit purposes. You cover the same gap, you keep the same money in your pocket, and your pension credit stays exactly where it was. I used to think the sensible thing was simply to claim your state pension the moment you reach the age for it. Then I worked through the numbers for someone born in 1960 and realized the ghost year had quietly cost her 2 full years of payments before she'd even noticed the gap existed. It changed how I think about my own retirement timeline completely. If you're anywhere near that 1960 to 1970 birth window, the first thing worth doing is finding your exact state pension age and your exact first payment date. They are not always the same moment, and the gap between them is where this trap lives. Even if you dodge the ghost year entirely, there's a third problem waiting the moment you actually start drawing from your private pension. Emergency tax. And this is where most of the advice you'll find gets it backwards. The first time you take money out of your pension, HMRC doesn't know your full income picture yet, so it applies what's called an emergency tax code, sometimes shown as month 1 or week 1 on your payslip. It assumes whatever you withdrew this month is what you'll withdraw every single month for the rest of the year. Say you take out £10,000 as a one-off lump sum. Under an emergency code, HMRC taxes that as if you're about to receive £10,000 a month for 12 months. The first slice gets taxed at 20%, and a chunk quickly jumps to 40%. You can end up roughly £2,000 overtaxed on money you only ever meant to take once. A lot of advice out there tells you to drip-feed small amounts to avoid this. It doesn't actually fix anything. HMRC still applies the emergency code to small withdrawals too, so you end up overtaxed in smaller pieces instead of one big piece, and you're still waiting on the same refund. You can spread the withdrawal across 5 separate months and still get hit 5 separate times, because the code itself never changes, only the size of the amount it's guessing wrong about. The real fix happens before you touch a penny of your pension. Log into your personal tax account on gov.uk. If you've never set one up, it takes about 5 minutes with your national insurance number and a phone to hand. Inside, There's a section where you update your estimated income for the year. Enter your expected total, your state pension, your private pension, anything else you know is coming. HMRC recalculates your tax code within about 5 working days before you've made a single withdrawal. I remember sitting with a client, Alan, after he'd taken his first lump sum without doing this first. He'd been taxed £1,200 in emergency tax on money he needed for a boiler replacement. His plan was to wait for HMRC to sort out the refund. 3 months later, he was still waiting. We fixed his tax code together, on my phone, in a car park, in about 10 minutes. His next withdrawal came through taxed correctly, no overpayment, no months of waiting. That's the real gap between the advice everyone repeats and what actually works. Drip feeding treats the symptom. Updating your estimated income before you withdraw treats the cause, and it means HMRC gets it right from your very first payment instead of your third or fourth. So that's the stealth tax, the ghost year bridge, and the emergency tax fix. But there's a reason most people who hear all of this still don't go and do any of it. And it isn't because they don't understand the numbers. Your brain treats 10 minutes on gov.uk today as more painful than a tax bill that won't show up for months. It's a well-documented bias. We consistently overvalue our time right now and undervalue the money we'll save later. In retirement, when every pound genuinely counts more than it used to, that bias gets expensive. It's completely normal to put off financial admin. You've spent decades working and saving, and some part of you feels you've earned the right to stop thinking about forms and tax codes. That instinct isn't laziness. It's simply what happens after a long career of either doing exactly this kind of thing for a living or watching someone else handle it for you. But this is one of those rare cases where a small amount of upfront effort saves real money. Not a vague, someday kind of saving, an actual figure you'd otherwise hand over to HMRC or lose from your benefits. I've seen people put this off for months, not because they didn't care, but because it felt like one more form in a life that already has enough of them. Then they finally sit down for 15 minutes and realize it was never as complicated as it felt from the outside. Here's the shift that actually works. Don't try to fix everything in one go. Pick one morning, set aside 15 minutes, no calls, no emails, and just open your personal tax account to look at your estimated income. That's the whole task. Look, don't fix. The next day, if something needs updating, make the change then. 2 short sessions, 10 minutes each, and you're done. Once you've done that, you've already avoided the 3 biggest traps we've covered. There's one more thing worth doing to pull it all together into a plan you can actually act on. Move 1. Check your state pension forecast and your national insurance record. Go to the Check State Pension Service on ov.uk and see exactly how many qualifying years you have. If you're short of 35 years, you can sometimes buy back missing years through voluntary Class 3 contributions, currently around £824 for a full year, which adds roughly £302 a year to your state pension for life. That's a break-even point of about 3 years. Worth doing if you expect to draw your pension for longer than that, not worth doing if you don't. Move 2. Plan your ghost year bridge properly if you were born between 1960 and 1970. Find your exact state pension age and your exact first payment date, and if there's a gap between them, cover it using your tax-free lump sum or ISA savings, not a taxable withdrawal from your private pension. That single choice is what keeps your pension credit and housing benefit intact instead of quietly disappearing. Move 3. Set your tax code correctly before you ever touch a drawdown. Update your estimated income in your personal tax account first, then make the withdrawal. Never just accept an emergency code and hope the refund arrives quickly, because it usually doesn't. If you think you're too busy for any of this, remember Alan in that car park. His 10-minute fix saved him £1,200. That works out to more than £7,000 an hour for the time he actually spent on it. Phil, 63, is a good example of Move 1 in practice. His forecast showed a 4-year gap in his national insurance record. We ran the numbers properly, and he'd have needed to live past 71 just to break even on filling all 4 years. So he bought back 2 years instead, which added £604 a year to his pension for the rest of his life. On the £1,648 it cost him, that's a return of around 73% a year, something no ordinary savings account could ever match. None of these 3 moves need a financial advisor or a course to follow. They need your national insurance number, your gov.uk login, and about half an hour spread across a couple of sittings. Frozen allowances are the new reality of retirement in this country, and they aren't reversing anytime soon. That doesn't make you a victim of the system. You've now got 3 tools in your hands: the ghost year bridge, the tax code fix, and the national insurance top-up that most pensioners never hear explained properly in one place. If you're worried about tax quietly eating into your pension, hit subscribe. Every week I break down the math behind headlines like this one, so you can keep more of what you actually earned instead of handing it over through a rule you never even saw coming. I don't know every detail of your situation, but I do know this much: the system is built to take what it's owed, and the only person consistently looking out for your retirement is you. Start with that 15-minute appointment with yourself. Open your personal tax account, check your forecast, see where you actually stand. You've done the hard part already: decades of saving, decades of paying in. This last part just takes 15 minutes, and it's the difference between the system quietly taking what it's owed and taking more than that, without you ever noticing the extra.